Thank you for joining iMeet. When you hear the tone, you will be the 26th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. I want to apologize real quickly. I've had the flu last week, so I have a coughing fit here. I apologize ahead of time. Anyway, we're going to quickly review the last couple of days in the market. It's been a wild couple of days here with the tax reform bill finally getting passed. We're going to take a look at some more of the sectors, look at different indexes, talk a little bit about what we went over last week, and also I want to do a little bit more of an education piece this time, hoping that you'll be able to see some of the analysis that I use and some of the alternative charts that I look at when I'm deciding what sectors and whether the market probably has more upside or downside. So let's go ahead and get started real quickly here. The last week and a half, I don't know, it's just been a wild ride with this tax bill thing. We saw some of the sectors maybe thought that we were going to have some problems getting that through last Friday, and then of course last Thursday we had that 400-point drop midday that we rebounded from. But anyway, yesterday was kind of an interesting day. I had some people email me, wanted to know if I thought that was a blow-off top. And it wasn't. There's several things that you want to look at. If you're not familiar with the blow-off top, it's when you have a big move like you did yesterday, where the Dow was up 300 points. But generally, you're going to end up negative. Now, the NASDAQ certainly had a big drop, and some of the other industries or indexes too. But that wasn't a blow-off top per se. You still had several indexes that made all-time highs, including the Dow, the NYSE. The transports also made a new all-time high, and the NYSE AD line made a new high yesterday. Those aren't things that are that are part of a blow-off top. So, despite what it looked like at first, it was just another volatile day where we actually had some. I think more or less it was a little bit more of the rotation out of the technology and into the financials and industrials and some of those sectors, maybe even energy, and just some selling into strength after we've had a run up into into the passage of the tax bill, where you took some profits on maybe some of the banks that were up, maybe 10%, 12% during the last week or so. So let's jump in here right away and get going here. Last week we had the Dow gaining 673 points. It was the best percentage move the Dow's had during the whole year so far. We were up 2.9%. For part of the day, we were up about 3.5%. But the CTI is a -1. This Friday, the CTI is going to go to a -3, and we'll stay negative for another week or two. I still don't see a lot of downside to this market, but the momentum index actually dropped to a -9 last week. If you wonder how we could be making new highs and that happened, the momentum index is measured by me, but looking at the performance of the other indexes and AD lines and all, and some other McClellan oscillators, some other things, accumulation distribution indicators, to see how they perform next to the Dow. And right now, the Dow Jones is outperforming everything. And unfortunately, part of that is because of it's a weight index where you have the stocks are 250 and Home Depot 185. When they move up 4 or 5%, it makes a big difference. You have something like General Electric fall down 25%, and it accounts for like 35 points of the Dow. So a little bit. I'm not really liking the way it's being measured right now, but that's what we have. So you might want to just keep kind of slide over a little bit, look a little bit more at the S&P 500. Sentiment index is also a -1. Still too much bullishness out there. There's a lot of bullishness, but basically a lack of bearishness. No one really wants to sell, and when we have these big moves up, you don't see much selling coming in off the sidelines at all. Top performing ETFs last week were retail and small cap growth and blend. Top industries were home construction, footwear, internet financial. We'll look at that a little bit later, and casinos. We also had crude oil prices move higher last week, which we'll also look at today. And we still seem to have these oil stocks lagging the broader market, but I still think we have some more upside to go in those, and I would be hesitant to sell at this stage. We also had big moves last week, which was good to see in the Dow Jones Transports and the Russell 2000, which we'll look at later. They had been lagging. The fact that they started to come back to leadership is a big plus for the market going forward. Here's the NYSE AD line. Again, this is not something that you see at a blow-off top. Now, if we'd have come in here at the end of the day yesterday, we'd have had 300 advances and 1,500 declining issues. We'd have more of a case. But the AD line is a leading indicator, and as of right now, we're still punching out new highs on that. We made a new high Friday and another new high on, yesterday. So we've had a couple of days in a row here of new highs on that. We also are getting expansion, once again, in the new highs, new lows, which is a sign of a healthy market. You can see up here we almost had, I think we had 292 yesterday. We hit 300 last Thursday or Friday or something like that. So that's all signs that we can still probably work our. We're certainly not going down in here. We're overbought. We have some churning to do, but this is still signs of a good, healthy market with broad participation. Here's the S&P 500. Here's that big drop down here on last Thursday. Didn't even come down to the 50-day moving average. Today we have a little bit of a pullback. I think we're about even. We're up 1 point right now. What you want to watch for on the S&P 500, keep an eye on 2,600. If we would get, which is still above the 50-day moving average, but as long as we stay above 2,600, 2,610 area, this the uptrend is intact. We're a little bit overbought. We had some negative divergence that was showing up in the market last week. That's rectified itself. Even on the MACD, it's showing that the trend, short-term trend, remains up on the S&P. All right, here's the NASDAQ. Again, still looks fine despite the pullback last week, which is pretty ugly on this rotation. We still have higher highs and higher lows. Still have not even begin to dent any of the key moving averages. A little bit of some slowing in the momentum again here, which is fine. Today we're having a little bit of a rebound. We're up half a percentage point, coming up here around that 6,800 level. That's right around where the pivot point is, but everything still looks fine on this thing. The AD line, again, we had this pullback over here. The rotation actually just started over here, so as you can see, there's not a lot of decliners. You have some the FANG stocks, which you have your Facebook that is down about $10-12 from its high from a few weeks ago. Amazon's had a real pullover, and a lot of the semiconductors were down about 3%, but nothing that you need to throw the baby out with the bathwater. It's just a little bit of working a little bit of overbought condition off. I think we'll be fine. These tech stocks should find a bottom in here soon, and we'll try to catch that here over the next week or two. And once again, also here, this is the new 52-week high lows. Almost hit back up to 300, which is a very healthy level on that. Not seeing an expansion in the number of the new lows down here. So again, you still have a lot of stocks, especially in the retail and some of the biotech and stuff. Still, the biotech's having a good day today, up almost 0.75%. Can lift the NASDAQ higher. So let me go here real quickly. Here's the Russell 2000. You saw this that we talked about for the last couple of weeks. There was a concern, a lot of negative divergence in here, and we still have some negative divergence on the Russell 2000. Even though we're punching out a new high here, we didn't get that on the MACD lines or the 14-day RSI. So a little bit of a concern on that. We're about flat. We're down 2 points. I still would like to see this move make a little bit stronger move on here, but so far still higher highs, higher lows. Here's the transports. Again, we saw this rolling over, broke down below the 50 and 100-day moving average, was a concern again. Turned on a dime here with this tax tax cuts and all, and worked off, very minor deterioration or negative divergence in this. You can also see a nice pickup in the advanced decline line down here, which shows a lot of good accumulation. A lot of this, some of this was UPS, FedEx was good. You had a big move in the airlines here recently. Also today you have, let's see, marine transportation is down, but you're having a little bit of a pullback, a little bit of some churning in the transportation index. That's fine after a move like this, but you're back above, back making higher highs and higher lows on this also, which is bullish. Okay, the last I want to show you on these indexes, here's the semiconductor index, and you saw this fall out of bed. Now, last week we talked about concerns in the technology about the negative divergence that was showing up. It doesn't always work out, but when you do see this, you want to be aware of it and say, okay, this could be a problem. And if we start to see a pickup in selling in this was forewarning us. We came down here yesterday. We broke the 50-day moving average. I don't believe we've 1240. Okay, we're still below the 50-day moving average today. So we'll see whether this thing is able to punch back out above that. I don't think this whole rotation thing is over yet. Maybe we get down to the 100-day moving average, but I don't see a lot of much more selling of this thing. Now down here you see we always talk about the 14-day RSI. We want to see it stay above 40 if it's still a bull trend. We did snap below that on Monday or Friday, but we are back above 40 now. We want to see this stay above 40 if we have some sideways trading over here. If it goes back below 40, that could mean that we are in for a little bit more downside, which would probably go down and test this trend line or even the 100-day moving average. So not out of the woods on semiconductors and technology yet, but I don't see this thing going, coming down to 10, 15% of that. So first thing I want to do real quickly here, we're going to go over some of the portfolio changes that we made. But the best performing sectors last week, we had, let's see, financials were up almost 4%, big move. Energy was up over 3%. Consumer staples, consumer discretionary, especially the retail sections, and the industrials were up good. The worst performing sectors, of course, technology down over 3%, and utilities was down 1.6%, which we want to take a look at on this. And the reason being because we're going to talk a little bit about what to do with utilities, even though it's been a good winter for us lately. What's happening with that and why maybe it may be time to lighten up a little bit on that. Okay, before I get into some of these sectors here, first thing we want to look at on the portfolios. In the sector industry portfolio, on Monday we sold SOCL, which was a social network ETF at 32.31. That was a 32.9% gain, and we sold PSJ, which was a software ETF, at 63.94. We lost 2% on that. We just added that about a month or so ago. What we added to that portfolio, since we stay fully invested in that, we added IAI, which is the broker-dealer ETF at 62.18, and we also bought RTH, which is the retail ETF, at 88.99. Both of those look like they have more upside to them. Both of them are up since Monday, up about 1.25% or so. So they've had a little bit of a pullback today. So those are two that I think you can probably pick up, or maybe even some of the stocks in that portfolio or in that group if you're looking to buy things right now. Now remember, I also usually don't buy stocks when the CTI is negative. I just think that there's the market's susceptible to some weakness, even though everything looks pretty strong here right now. We'll probably start adding to the portfolios again later on. We also sold in the model portfolio MTOR for a 23.25% gain. We also sold in the aggressive growth portfolio a couple other tech stocks. We sold FORM at 15.60 for about a 2.5% gain. Yelp, YELP, at 43.89 for a 2% gain. And finally, we sold Toyota Motors, TM, out of the Growth and Income Fund for about an 8.5% gain on that. So let's look real quick at some of these sectors like we did last week. First off, we want to look at the technology. We talked about this negative divergence that was going on, especially also in the MACD. We did get that breakdown in here. So far, we're staying above 40 on the 14-day RSI, which is good for the technology sector in general. Now, of course, the semis underperformed last week, but it's not all about semis and technology. You still have other parts of that group. You have some of the networking and that type of thing that you can still look at. Some of the broadband things, that type of thing. So what we're going to look at right here, we did come close yesterday or this morning to the 50-day moving average. We want to keep an eye on that. If we get down to that and bounce off of that, that's a good sign. But we had this gap from a couple weeks ago. If we break below that gap, you're probably going to come down here and have some selling pick up again, and we may go back down like the semiconductor. We may come down here and test this 100-day moving average. No signs of that yet, but as you can see where this 50-day moving average is, it's right where that gap is. So we want to keep an eye on that. We're up today on a nice little rebound, but again, if that breaks, that could induce a little bit more selling. Part of that is, we talked about it before. End of the year, you have about 3 more weeks. You don't want to have portfolio managers aren't going to, come in here if they start to see some selling. They've got 20 or 25% returns this year. They're not going to give them up and ride anything down. So they're going to be pretty quick on the trigger to lock in some gains. If that's what happens, we start to see some selling pick up. You will see again some of these things overshoot a little bit as these guys try to close out positions before the end of the year. So just keep that in mind a little bit on that. We also talked last week about consumer discretionary. This is XLY. Big breakout here over the last week and a half, confirmed by momentum is strong on the 14-day RSI. MACD is confirming it. Good accumulation. I like to see on strong trends. I like to see the 30-day stochastic stay above 80. We're well above that in the 90s over here, and we look good on that. So it is overbought to say the least. But we talked the last few weeks about strength in some of the home improvement retailers. Home Depot in here has been on fire again. Lowe's. We talked a couple weeks ago about that Builders Source BLDR. It's had a nice move up here the last couple weeks over for a low price stock. We also mentioned buying some of the several retailers and some of the portfolios over the last week. Surprisingly, even some of the brick and mortar that showed up over the last 4 or 5 weeks. We talked about L Brands, which we last week or the week before that we added. American Eagle, AEO, is up about 30%, and even Urban Outfitters, we're now up about 48.7% on that stock in about a 5 or 6 week targets. We're not buying anything right here now, but we're not selling those stocks even though they've had this big breakout in here. So, we may give some of the profits back if the market rolls over because they're overextended, but we're not selling those yet at this time. Okay, over here, this is the RTH. This is the retail ETF on this, and you can see this trading range over here. This big breakout here. Breakout's confirmed again by the 14-day RSI, and more importantly, look at this AD line down here. Just going kind of flat while we're in this trading range. Boom! This isn't you and I buying these. These are the institutions buying these things ahead of this breakout. It was actually kind of a surprise move, because we've been hearing so much about Amazon's killing the retailer, but in this case, doesn't seem to be the case. We're seeing a nice big move in here. You can buy some. I'm not necessarily chasing these retailers in here, but I'm not selling either at this stage. I think they probably have some more upside. Okay, here's XLF. This is the financial. We had another big breakout in this. It came down here. We walked up and down this 50-day moving average, which held here for several weeks, which I thought was bullish. We had some, this breakout here is confirmed by the 14-day RSI. Accumulation is not as strong as you would think. However, with the institutions that have been buying these things, hopefully we've been buying these on pullbacks for quite a few months also. So these have some more to go. When you see this thing here, this is kind of an interesting pattern. I hope when you see this, one gap, you have to be careful that you don't have a break, like a shooting star or something like that, where you come out here and you go up and then you come back down and you fill up this gap. What this is normally referred to as a breakaway gap. When you start to have the breakout, you gap up, and then you have another gap above that, which continues. It's a continuation pattern. So I think with the financials, you may get a little bit of a consolidation in here, because they've had such a big move over the last week or so. But again, on pullbacks, you want to buy the banks. Today we're flat on these things. But remember, the FOMC meets again next week. I think we're at something like 95% chance that we're going to have a rate hike. That's good for the banks and the financial stocks, insurance companies. Also, lower rates, lower taxes is actually a accommodative policy that is going to be, stimulate economic growth, which means more loans. That's also going to be good for financials. So you're getting a double whammy here for, or double boost for financials at this stage, where you have, the tax cuts, which should, kick in with some inflationary measures, which is good, which means higher rates. Then you have the FOMC also forecasting that they want to keep these, maybe 3 or 4 more rate hikes in 2018. So we're buying these things on the breakout, big move, but I think these still have a ways to go to move higher. All right, now one of the things that I wanted to show you real quick, when you have, before we look at some of the other groups, when you have something like this tax cut, this is, I said we have a few education slides to look at. I'm a big fan of 50-day relative strength, or the 3-month ROC, that type of momentum thing where I look at to buy stocks. I want to see the 50-day RSI relative strength above 1, or maybe even above 102, 103, and I want to see that the power rating on market is starting to move higher also with that. So when you come in here, rather than just go to industry group and go, okay, let's go click on the relative strength and see what we have here, because this is going to, this is in general, this is going to tell you what groups are leading the market. But when you have these 400 and 500 point swings, or you get a 600 or 700 or 800 point move in a week, you can go into the industry group analysis and click on the 1 week percent change, because what that's going to do is that's going to say, okay, over the last 40 days, 30 days, we've had some accumulation in certain groups, but now that what we've been watching, in this case, the tax cuts happens, okay, what is moving right now? In this case, we look at here, we see especially retailers. We actually have the food retailers, internet financial, which we're going to look at and talk a little bit more about that, apparel retailers, steel, which was a little bit surprising. Then you come on back down here and you have all the southern banks and money centers, here with the railroads, eastern banks, central banks, and on down through here. So in this case, you can see, okay, over the 50-day, I like this. We had casinos, we had home construction. Those are still all relative strength industries or sectors that are outperforming. But in this case, we can find out once that bill passed, what benefited the most from that, and what spiked the most. That again, this isn't mom and pop decide. Also, we're going to buy these specialty retailers and stuff. This is the institution saying, okay, with the money that I had, I've been holding a little bit back just in case. Okay, we got the tax cut, boom. Let's put the rest of it to work on these banks and some of these other stocks. So that's something I hope you in the future you can think about that if we have some kind of economic event or something like. In fact, the next thing I'll tell you about, now that we have the tax cuts behind us, we'll be starting to talk about the new budget. Again, when the budget begins to pass, we're going to want to see, okay, now that it's passed, you have institutions buying ahead of time. We know the defense sector is going to have a big big build up in more money. But we also want to see that 1 week if they throw more money into it. So when the budget begins to come up here in the forefront here over the next couple of weeks, that will be the next time we'll probably look at these things and say, okay, now we just had a game changer. What are the industries and sectors that are going to outperform here? What did the institutional players buy right now? All right, along with the financials, here's KRE. This is the regional banks. When you saw back there on the industry group analysis, what jumped over here the last week? Okay, well, we had this big fall down here, but the regional banks also outperformed. You saw them break out of this little resistance area. they're hitting new highs. And over here you saw, with the big banks, you didn't see the breakout like you did with the regionals. So you had a little bit more buying in the smaller regional banks. And again, one of the reasons for that, tax cuts are accommodative for the economy, and some of these smaller regional banks are going to see big upticks in their loan growth, probably from the tax cuts. So that's why you're seeing this, outperforming some of the bigger banks. All right, we talked about last week. We bought the this week we bought the IAI broker dealer security shares in the sector and industry group. All right, we had the same thing going sideways in here, and we had the breakout going there, which was confirmed by the momentum in the 14-day RSI. Surprised a little bit with the accumulation distribution over here, but I think we'll see more of that. Okay, again, the broker dealers, and especially the broker dealers like Schwab, TD Ameritrade, E-Trade, some of these the internet financials that don't have a lot of brick and mortar stores. Every change in rates goes pretty much to their bottom line. I remember talking to someone at TD Ameritrade. Every half point of interest rates, if rates go up, provides something like, I forget how many millions of dollars to their bottom line just because of the change in rates and the difference between the longer term and the short term. So that's why you see this big jump in here in the broker dealers. If you want to go over to the industry group, you can look at the security brokers. Here's versus the S&P. This will give you a list of what's strong. We're basically long all of them. You got Legg Mason, you have LPL, Raymond James, Deutsche Bank, Stifel Financial. You can go in these and look at the chart yourself. I'm not going to go over all the individual ones, but again, this will give you some stocks that you may want to look at for there. And I still think you still buy some of those. Here's the one we talked about last week that we had bought, the IAK. This is the U.S. Insurance ETF. We had this consolidation over here. Once we got the tax cuts, accommodative, boom, we got the break. Now we also have a rate hike coming next week. Again, that's bullish for this group. So we get this breakout, we got a gap up, and I think we're starting to see good accumulation in this over here. And you actually are getting a pretty good break on this because this is when the hurricanes came in. They had quite a sell-off. They bounced back pretty quick. Now, one of the things when you look at something like this, where a sector that had a big pullback, there's two trains of thoughts. One of them is, rising tide, lifts all ships. But again, relative strength will play into this factor, and the fact that the institutions are going to buy the ones that are outperforming right in here are the ones that bounced back the quickest. The reason they bounced back the quickest was because the institutions knew that they were in better financial shape, and they were buying them rather than looking at, rather than going, this stock came back, it hasn't bounced back, let me buy that because it's the other ones all have, this one hasn't. That one hasn't bounced back for a reason. The reason is it's not as good shape as the other ones. So keep an eye on that. Okay, the next slide here real quick. And here's the group industry, life insurance. Life insurance has to put all their money in CDs, so when the rates go up, they make more money on their assets. That goes right to their bottom line. Here's several that you can look at in the industry group on life insurance. Okay, here's industrials. We talked about this last week. We got right over here. We're holding the 50-day moving average. Got the big lift on that. Several reasons for that, which we're going to go over here in a minute. You saw some nice accumulation in that. A little bit of a pullback today, but nothing big. But industrials look fine in here. They were able to hold that support level. Okay. Now, one of the things we talked about, a little bit of a breakdown last week, that this thing turned around. But the reason why this group broke out is kind of simple. And again, this is we're going to talk a little bit about intermarket analysis, which I hope you which we do occasionally, and why the intermarket analysis would point you to this group as an area that you may want to be buying or looking at to buy in here. Okay, pretty simple is this. This is UUP, which we look at, and this is the ETF for the U.S. dollar. All right, over here, when you saw this coming down in industrials, this little side go over here. Okay, what was the dollar doing? The dollar was going up. Okay, when the dollar goes up, that cuts into the profits, especially overseas in the multinational industrials. And when the dollar's going up, that means that probably the rates are going over here. We're just kind of going sideways. The dollar got weaker on this, I guess because of the tax cuts. I'm not exactly sure, but when the dollar was getting stronger, industrials will go down. Okay, now we look at we're back here. We're probably going to maybe come back and test this $24 level, which we looked at it back here in the summer, which we did. It went a little bit lower, but we were able to hold right around that area and work our way up. So now when we have the tax cuts, you want to, and again, this is the intermarket analysis part. You want to know how are the tax cuts going to affect the U.S. dollar? All right. Well, okay. Number one, tax cuts are thought to be inflationary. All right. Okay. And number two, when you have higher inflation, that normally is going to cause rates to increase faster than what you actually want. And number three, that could cause the U.S. dollar to increase in value as rates tick up. So we have this pullback, and we're kind of going sideways while we're watching this to see what's going on. I don't think the U.S. dollar is going to go down much lower than this. You may get a pullback to 24 in here, depending on some of the economic data. I think one of the things that's keeping the U.S. dollar also is the volatility of President Trump. That keeps investors a little bit on the fence at times. However, once these we get this, it's not all cut and dried, but what would cause this dollar to move back up, which I think it will, going out a little bit further, would be that as the rates tick up, which we're going to get here, the first one on next week. But as we move forward, we'll look at some of these other charts and investment vehicles to see what else we can get. But be careful on this thing. As this thing starts to move back, we're fine. But once this thing starts to break back up above the 50-day, we may start to see the dollar strengthen, which would not be as good for the market. But anyway, keep an eye on this. We got the pullback that we're watching here, but we don't want to see this thing get too strong as rates begin to pick up. Okay, last couple of charts. I want you to go ahead and get your questions ready. This is energy. We've been pretty right on the money on this thing here. We talked about last summer about we thought this rally in oil stocks and energy would probably be more than just coming up here and bouncing off the resistance line. It's been in place for a couple of years. We got that breakout. We broke above the 200, came back, tested it, got another high. We're breaking out here again. Some negative divergence in this. Remember, like with some of the groups we looked at, this can be a little bit of a concern. It's not yet. We've talked about buying the oil stocks. I still am a holder of the oil stocks. They have not outperformed as much as the XLE has. Whether XLE may have gone up, the price of oil has gone up, from like 51 to 58 or 59. You have not gotten that move in the oil stocks, which is a little bit surprising. Part of that is I think there's still a lot of people that are short oil. We're going to look at this, as you can see what the divergence between the two charts is. This is light crude oil. Again, when you're looking at buying the energy stocks, why do I think we want to hold on to it? Well, this is oil itself. We're not getting to a move like this in the oil-related shares. We're going to talk about that in just a second. But you can see the outperformance in the commodity itself. We've called this pretty well over the last couple of years. And again, my upside target in here has been 60 with a possible, if we get some short covering, we could get a rally up to about 62. I'm not in the camp that we're going to see 70 or 80 anytime soon, despite this synchronization in the global economies. However, because basically above 50, you have more U.S. rigs coming back online, and I think that caps prices up in this 55 and 60 area tops. And also, OPEC has lost a lot of its power to generate the supply and demand on the crude oil stock. So again, a little bit of very minimal negative divergence on this, but accumulation remains fairly strong on here. I think we can still ride the oil stocks higher, through the end of the year, at least for right now. Okay, here one quick one over here again with two more quick charts. One of them is materials. Okay, this thing seems to be slowing down. We're punching out to a new 52-week high, but look at the accumulation. That's not so much. Part of this, crude oil also goes into this. Part of the materials we're also seeing in the buying, home construction and all, that's helped out with this. Home construction, we may look at again next week. Some analysts are saying that the tax bill could cut down on home construction and stuff. But another thing of this thing here, a lot of this is infrastructure spending, which we haven't heard much about. However, with the budget coming on board again, the infrastructure spending and on the new budget may pick up again. If that happens, this thing can work its way good. Doesn't look like it's going to roll over by any means, but I think we need a little bit of a shot in the arm to see this thing move up, and I think maybe the budget could do that. All right, lastly here, before we get to your questions, this is utilities, XLU. Kind of a pullback in here. We're down again today, I think. Yeah, we're down about 1.5% today. You've had some nice accumulation in this. Utilities aren't just a yield play anymore. They still are bought, as a yield alternative for older investors. But the Dow Jones Utility Index is up about 14% this year, not counting dividends, which is a pretty healthy return for a very conservative investment. I want you to keep an eye on this over here. I think we probably will see more downside in utilities, mainly because as rates tick up, it's just as seen as maybe I can get a little bit more growth out of something else, which is I may want to trim off my utilities. But also, so we want to watch this 50 and 100-day moving average on XLU to see if we can come down to this area. That would be in line with the 100-day moving average with this trend line. So I don't see, as we see some negative divergence, a little bit of slowing in the trend. I'm not looking for a big pullback, but I think you can see more sideways action of what we've seen over the last year on utilities. But still only trades at about 9 times earnings, so there's still this, historically, that's not like the rest of the market, which is really, really expensive. Historically, this thing's going to trade around 8 or 9, so we're kind of in line with that. It's not like we have the consumer staples trading, Procter & Gamble and Kimberly-Clark and stuff traded 20 times earnings, where normally they traded about 11 or 12. So, again, I believe that XLU will be, I don't see a lot of upside in that right now. Okay, as far as the CTI goes, we're going to be only to a -3, which is not, only 2 of the cycles are bearish. I don't, like I said a couple weeks ago, even if we get a pullback down to the 50-day moving average, that's basically a 2 or 3% pullback. So this isn't something where I'm loading up on defensive or hedging my portfolio looking for a big pullback. I don't think you should be either. All right, we got a lot of questions coming in. I'm going to see if we can jump to those real quick. Gone too long again, but I'll see. Okay, what can I access portfolios that you mentioned? Because portfolios are something we're going to be rolling out here after the first, maybe by the end of the first quarter in 2018. But since it's taking us longer to get them out, what I'm going to do is on our Tuesday Tech Talks, I'm going to give you the buys and sells on that. We'll talk a little bit about the performance for 2016, 2017, not back tested, actual performance numbers on that. Okay, we'll take a look at Cisco, CSCO, EWG. All right, EWG, Linda, we on the developed portfolio, international, we sold Germany on Monday. We also sold Canada, and we picked up, I think it was ADRD and something else. And out of the emerging market portfolio, we sold GXC, which was China, and we picked up EWG. We picked up South Africa, which is EZA. All right, what about KTOS? KTOS, we'll take a look at that also. Okay, let me get out of here, and we'll share the screen. Okay, KTOS, still disappointed in that thing. I believe that you can still be accumulating down here at this $10 level, and I think you'll probably get a little bit of a pop in that thing once the new budget comes out. Very cheap stock in the $10. Deutsche Bank just came out with a $13 price target on KTOS. So Don't be afraid to look at that. We'll take a look at KTOS real quick before we go to Cisco. Okay, this is where they kind of killed themselves. They came out with a big secondary offering, brought out 13 million shares priced at 12 and a quarter. So I think you accumulate down here where it seems to have found support. Things look like they're starting to pick up a little bit on the indicators. Once you get above 1067, get above that 200-day moving average, you're going to have some resistance up here at this 50 and 100-day because that's where the secondary was priced at that 12 and a quarter. Some of these people that bought that and are lost money on that are probably going to kick it to the side once it gets back up to here. But hey, 10.10 to 12, $2 stocks, 20% from that level. So I wouldn't be afraid to be accumulating down here at this $10 level. All right, Cisco. All right, Cisco looks pretty good. Okay, when we talked a little about the XLK, how it's not just semiconductors. We talked about the networking stocks. Some of those have gotten killed, but Cisco's a little bit overbought in here. You have some people take some profits in that, no big deal. We're able to hold well above the pivot point, which is 36 and change. I think, I certainly wouldn't be selling Cisco in here at this stage. You'd probably go sideways on that. Like I said, I believe the technology sector is probably close to finding a little bit of a bottom. So, this is one of the technology stocks that seems to be working out well. Okay, another question coming in here. What about Microsoft versus Intel? Okay. On Intel, we have it's pulled. This hasn't pulled back much. You want to watch on this thing here. If selling does pick up this gap over here, that's around 43. I wouldn't want to see Intel break below 43, but I think you're getting close. You're at 46 in the 14-day RSI. That gets down to 40 and holds. You have a pretty nice. That would be a good buy on that section. Great accumulation here. This doesn't look like to me like people are bailing, jumping ship on Intel. I think the longer term, the products that they have out, especially with that after buying Mobileye and some of that, that's a long good order. If I could see Intel down here at 43 and it starts to rebound off of that, great. If it breaks below 43, decides to fill that gap, anywhere between 40 or 41 would be a buy. But this doesn't look like something that's just getting krilled. Above 45, you probably want to be in that again. Okay, Microsoft, pretty bad day on what was that, Monday. Of course, that was with the big cap tech stocks, with the Facebooks and all that. They came down here. We're in the process of filling this gap here. I think you're going to see Microsoft go a little bit lower in here. I think you've already filled half this gap. You're going to probably see Microsoft come down here, break this 50-day moving average and come down to the 77, 78 range. We'll see what happens in that stage. But this is pretty good volume on this break. And once, like I say, if it had held 80, if it had held 82, and if it can get back above 82.50 or so, that would be good for the stock. But if it doesn't and starts to have another down day in here, you probably have a little bit of concern on that. At least, nothing like it's falling out of bed again. But I think you probably go down here at least test that. We're at 82.27 right now, so we had this little bounce in that, which is, when you look at it now, this is kind of where the resistance is going to be. This S1 at 82.40 or so. It needs to get above like that. If it hits this and bounces back, you're going to go down here and test this, fill in this gap. Okay, no more questions. Okay, TRV. Travelers, that's in that insurance company. So you're in a pretty good, you're in the financial group, which is good. Having a bit of a pullback here today. I think this was, part of the pullback today was on a downgrade based on valuation where it had jumped up. I can't remember who it was. But let's take a look at a couple of things to see if you saw something that worries you here. Okay, this is that negative divergence. You're breaking out to a new high over here. It wasn't confirmed by the 14-day RSI or the MACD. A bit of a concern, but I don't think I would buy Travelers on weakness in here. Again, look at the accumulation in here, despite that pullback, some sideways movement. I would be I like the sector. I think you buy on weakness on Travelers. Okay, I've gone way over today. Listen, we had a good crowd today. I really appreciate all the questions and all. And I also wanted to let you know I appreciate you taking time out of your busy day to join me on this. I hope it was valuable to you and you're able to make some money off of what we talk about. If you have questions during the week or you want to go over some of the things that we talked about, you can email me at support@marketedge.com or email me at thedoc@marketedge.com, and I'll answer you personally and get back to you. All right, everybody, have a good week, and we'll see you next week.